after a decade of roaring higher year after year, outperforming pretty much every other asset class out there under the sun. Precious metal seems to have really gone into major bear market mode starting the past fall, declining for the most part slowly and steadily since October. Then yesterday, the price of gold just completely collapses, just swoons, down 9% in a single session, finishing the day at $1,350. That's an ounce, after dipping even lower. And today we get a 2% whiplash that was fast enough to give you whiplash. Remember, as much as I don't like to see gold go lower, I think it should always be a part of a diversified portfolio, like I told you yesterday, as insurance against inflation and economic chaos, or as an alternative currency to the euro, the yen, the dollar, at a time when central banks around the globe are printing money aggressively, obviously in a devaluation down method. Now, you know I think this monster decline in gold is being usually exacerbated by margin calls. And that's when money managers buy gold with borrowed money, and then when the value of their position, their gold position, goes down, the bankers ask the fund managers to put up more collateral. If they can't come up with the cash, then the margin clerks are allowed to just sell the gold these funds own without their permission, without regard to price, in order to repay the money that was borrowed in the first place. Sell, sell, sell. Now, gold is especially tough because a substantial amount of gold is bought with borrowed money, as the margin rules for this commodity are much less strict than the margin rules, say, for you when you buy stocks. The gold traders are also an incestuous bunch, people. I'm sure they know that one of their number was in trouble yesterday, in trouble with margin, carrying an outside position they couldn't afford. You know what they decided to do? They decided to break him. I think they decided to break him with a bear rate. Don't laugh. That's what happens. Plus, gold's very technically driven. And when the precious metal broke below 1,500, it brought out a plethora of chart followers who blew out of their positions, and I kept hearing shark circling on certain accounts. If this technically bearish scenario is indeed playing out, and if we have a hedge fund going wild situation in gold where money managers who played with margin are now getting burned or being the target of a raid, it can be very difficult to tell when and where the precious metal will bottom, because first of all, it doesn't really have an interest rate connected to it. It doesn't have a dividend. It's just out on its own. And that's why tonight, when it's out on its own, you know what we do? We go off the charts to try to answer that question. And we're doing it with someone real good, Carly Garner, terrific technician, who's the co-founder of DeCarly Trading, author of Trader's first book on commodities, as well as being my colleague at TheStreet.com, and the person who said that interest rates were going to go down again not that long ago, when everyone thought they were going to shoot up because the Fed was going to stop QE3. No. Now, before we get to the chart, I want to mention a tool that Garner often uses to good effect. The Commodity Futures Trading Commission's Commitment of Traders Report. It's a technical term. Comes out every week. Contains a lot of information about which groups of traders are playing various commodity markets in which direction. Garner warns that this report isn't typically as useful with gold as it is with some other commodity markets, simply because large speculators, the big money guys, and small speculators are almost always net long gold. That said, she found something very interesting in the latest report. The large speculators, the big boys, are now holding the smallest net long position in gold since mid-2012. So, what happened the last time the big boys trimmed their long positions this much? At the time, the price of gold was at $1,530. And then it ran up quickly when they got to this level to $1,790. That's a 17% gain. So immediately Garner's thinking, if we follow that same pattern here, there's plenty of room for the upside once the selling is exhausted. That puts her in the buy camp. But when will the selling be exhausted? Could be a tepid buy right here, so that's a big question. So why don't we do this? Let's take a look at the weekly chart of the price of gold. People, when I tell you that this chart is controlling, you must believe me, because this is a very technically driven instrument. A couple of things here. Garner points out that gold was already trending down, but the huge breakdown came last week when Goldman Sachs issued a bearish recommendation on the precious metal. Came out around 4:30 in the morning. I was shocked. It was already down a lot, but they were using a downside price target of 1450. As it turned out, that level turned out to be the starting point for the accelerated selling. The starting point, not the end. And Garner thinks 1450 could now act as a ceiling of resistance on the way back up. In other words, a lid. Think of it as a lid. Now take a gander at the relative strength index. This is the RSI that I often talk about, okay? This is an important momentum indicator that can help measure whether a stock or a commodity like gold has become overbought or oversold. And something incredible has happened here, people, for the RSI for gold. It has dipped below 30. I mean, that is just incredible. That is huge oversold territory. For the first time since Well, before the financial crisis. In fact, looking back over the last decade, Gardner couldn't find a single instance in which the gold market was more oversold than it is right now. So it's no wonder that gold bounced today, as anything that gets this oversold is a prime candidate to rebound. I love the RSI because I like overbought, oversold oscillators. They give you a sense of coiled springs. What else? Gardner sees a strong floor of support for gold at 1320. Now, that is a level, by the way, a level that held overnight. And she thinks there could be a psychological support at 1305. These are all crucial levels, people. Gardner believes these levels should hold for now. But buying gold here as a trade or an investment rather than insurance is like, well, here's my chart, okay? This is my chart. You ready? You know what that is? It's a falling knife. She can't rule out the possibility that if these levels don't hold, gold could go down to 1285. That is her complete downside target if it gets there. Gardner thinks, though, it's much more likely that this floor of support from 1305 to 1320, that's 1,320, does hold. And in that case, we could see a routine bounce back, which could take gold to the 1450 level. Remember where Goldman put the sell on it? Right there? That's where they said it was headed way down. That's nearly $60 above where gold's currently trading. Now, the 1450 level also coincided with gold's sharp downtrend resistance line. Okay? And if they can break out above those levels, Gardner thinks this oversold bounce could turn into a genuine rally. No, was anyone else saying that today? So if we get that breakout, the Gardner could see gold running up to the next ceiling resistance, which is back to 1,500. And if we can break through that level, she thinks we're off to the races. Next resistance, 1,620. And while she's not counting on it, that move could go to 1,670 and wouldn't be totally out of the question. This woman Carly's bullish. If these potential targets sound too rosy to you, remember the last time gold was this out of favor? Middle of last year. Do you know what it did when it was this out of favor? It went on to rally 17%. Plus, if you look back just a few short months ago, these are the levels that gold was trading at. Now, here's the bottom line. Carly Gardner's chart work doesn't tell us that the pain in gold is over. No, not at all. But it does suggest that it will end, possibly soon, as the weak-handed margin sellers may be wiped out, the bears will be circling and wipe out the prey, and the precious metal is so oversold.